Hi, welcome to STANLIB's weekly economic podcast. My name is Kevin Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And for this week, I think we need to focus on South Africa's inflation data for the month of June. The numbers released by Stats SA last week, and it showed inflation moving up quite sharply to 5% in the month, with core inflation jumping to 4.1%. So those numbers were a lot higher than expected, and I think it's worthwhile to unpack what pushed the inflation rate up and what is the expectation for inflation over the coming months. The second topic, and it follows from the inflation discussion, is the Reserve Bank's decision last week to leave South African interest rates unchanged. At the time, most analysts, including ourselves, expected the Reserve Bank to increase interest rates by 25 basis points. So I think it's useful to have a look at the interest rate decision by the Reserve Bank. Was it a policy error? What was their thinking around that decision? And what is the outlook for South African interest rates during the remainder of this year, given that we've still got an elevated inflation rate with risk to the upside? So I think two key topics to have a look at. Internationally, there wasn't a lot of data out last week. We did have the ECB decide to leave their interest rates unchanged, although they warned that there is upside risk to interest rates in the second half of the year. In the US, we got the weekly jobless claims, which fell to the lowest level in, I think it was 50 years, incredibly subdued numbers suggesting ongoing strength within the US labor market, and certainly a reluctance by companies to get rid of staff because they recognize that skills are difficult to find, and that if you get rid of staff, then you may have a problem down the line if you want to expand your employment base. So most companies are adopting a sort of staff retention policy as they go through this particular phase of the business cycle. In terms of the tariff announcement by the Trump administration, I don't think there's a lot that changes. It's got a lot to do with the legality of previous tariff attempts. I think this process is probably legally more sound. So I'm expecting that these are the tariffs that will persist from the Trump administration for the remainder of President Trump's term. And then we'll have to see what the next president decides to do in terms of the tariff framework. So I'm hoping the tariff situation does settle down to some extent. But for this week, SA inflation, SA interest rates, and I think two important data points out, and discuss what that means, I think in particular for interest rates in South Africa during the remainder of this year. So let's start with the discussion on South Africa's inflation data for the month of June. During the month, CPI went up by 0.7%, which is substantial under any circumstance. Obviously, the market was thinking that inflation would only go up about 0.4, maybe 0.5%. So it surprised strongly to the upside, which pushed the annual rate of inflation up from 4.5% to 5%. And clearly at 5%, it is quite different psychologically. Many people will now reference 5% as the prevailing rate in terms of wage negotiations or other discussions, and so it does increase the risk that inflation becomes embedded at a higher level. What contributed to the increase during the month? There were a couple of categories. Food inflation went up 0.5% in the month, which obviously added some upside pressure. Overall, you would say at the moment, food inflation is fairly subdued. The annual rate of food inflation sits at 1.4%, so that's well under control, but clearly we are looking at the El Nino effect, which could impact our weather pattern towards the end of this year and into next year, which may then result in higher food inflation. So we've got to be cautious about the outlook for food inflation relative to a number that at the moment appears fairly subdued. The other area that pushed inflation up was housing, particularly the rental component. I didn't expect it to go up as much as it did. To me, it surprised strongly to the upside, and it's difficult to ascertain where that pressure came from. There have been some reports that house prices in Gauteng have moved up a little bit relative to a very subdued level. Maybe that contributed somewhat. But overall, you would say that the housing market is fairly subdued. There's not a lot of new housing activity taking place. So I don't think that the rental component for the moment will become problematic. Obviously, if the economy were to gain a lot more momentum, we were adding a lot of jobs, then yes, you would see house prices move up and the rental component move up. But for the moment, I don't think there's a huge amount of additional pressure within the housing sector. And then transport inflation added a lot in the month. That was partly to do with the fuel price, but it actually had a lot to do with the cost of passenger services, particularly taxi fares. Taxi fares in the month went up 11.5%. It was way higher than what we had anticipated, and clearly that added quite a lot to the overall inflation rate. At the same time, the cost of e-hailing services went up. I think it was about 8.5%, and you saw a similar increase in the cost of bus fares, particularly long-distance bus travel. So all of those contributed to the inflation rate, which then in total surprised strongly to the upside. So what is the outlook for inflation? You would have to say that there is further upside risk, because we've got a significant under-recovery on the fuel price, which could add to our fuel inflation rate over the next month or two. And I don't think it all necessarily gets reflected in the August price adjustment. We could find some of it roll over to September, but a hell of a lot depends on what happens to the international oil price, which then in turn depends on the Iran-US conflict, which is very difficult to forecast. But we're assuming additional pressure on our fuel price over the next month or two in terms of our inflation forecast. Then we've got the El Nino effect, which may add some additional pressure, and then we've got some potential upside risk because of wage adjustments. So you would have to say that the upside risk from here is more pronounced than downside risk. And so we are expecting that inflation over the next 6 months can get closer to 5.5%, further away from the target. And so that then immediately pushes us into the second topic. And the second topic of discussion is, why did the Reserve Bank decide to leave interest rates unchanged? The expectation was that they would hike 25 basis points. But if you consider where inflation's at the moment, 5% with upside risk, then clearly the more prudent decision would have been to hike interest rates again. There are a couple of factors that I think led to their decision. The first is that, unfortunately, the Reserve Bank's update on their inflation forecast, so this is the forecast done by the Reserve Bank itself, did not take account of the latest inflation number. Those numbers were actually put together and presented on Tuesday last week, which was a day ahead of the release of the inflation data. So the Reserve Bank's own inflation forecast actually shows inflation moving down to 4.2% over the next 3 months, rather than moving up closer to 5.5%. And that's a significant difference in outlook. And clearly, if you're doing the forecast before the 5% inflation data was released, then your numbers would be substantially different. So it's got a lot to do with the timing of how you update your inflation forecast. The second thing I think that contributed was, on the day that the Reserve Bank made the interest rate decision, they start that meeting at 9 o'clock. The inflation numbers were only released at 10 o'clock. And so they had to digest the latest inflation rates in the midst of their discussion, which I would argue is more difficult to do. You don't have the time to fully incorporate the new inflation data in your outlook, in your discussions, and maybe that contributed to a more lenient approach to interest rates. Hard to know for sure. The Reserve Bank obviously argues that they took the latest inflation rate into account, even though it was released on the day of their interest rate discussion. But my suspicion is that it's difficult to take it fully into account. And so the decision was, by a vote of 4-2, to leave rates unchanged. It also then increases the prospect that the Reserve Bank will have to increase interest rates at the next MPC meeting, which is in September. If I consider where the latest inflation rate is, the potential for upside risk to our fuel price, the potential for some additional second round effects because of the higher oil price, then I would suggest the Reserve Bank will have to increase again by 25 basis points in September, and it's not impossible that they have to go again in November. The market at the moment is pricing in two further rate hikes of 25 basis points each. There has been some discussion of whether the Reserve Bank will be forced to hike 50 basis points in September as a sort of catch-up increase. I think that's a bit unlikely at this stage. I don't think the Reserve Bank would be prone to that type of decision under current circumstances. The economy overall is fairly weak. and interest rates are already fairly elevated. So I think the Reserve Bank would continue to adopt a fairly cautious, steady approach to interest rates. So you would factor in another rate hike, at least one before the end of the year, possibly two. And then importantly, next year, we've got inflation coming down quite nicely, particularly in the second half of the year. And so if the Reserve Bank gains confidence around that inflation forecast, then they would probably be willing to leave interest rates alone at that point, with the prospect that you could start to see interest rate cuts in the second half of the next year, or in, 2028. So it does set us up for short-term pain in terms of additional rate hikes, but then over the medium term, we should be able to benefit from inflation coming down and the new inflation target. And hopefully at that point, we are able to then push through significantly lower interest rates, which I think would help us in terms of economic growth, fixed investment, the cost of capital. All of those good things would then get a boost. But we've got to clearly get through the next 6 months in terms of elevated inflationary pressure and the real prospect of a further hike in interest rates. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.